Hello and welcome to the second episode of Inside Options. I'm Jane Vigi. Joining me once again is James Boardman from the Equity Derivatives Division of the JSE. James, I think anyone watching now wants to know just how much money they can possibly make, and trading options gives us that ability, doesn't it?
Absolutely. Options are a fantastically useful financial tool to have in your arsenal. And as we mentioned last time, there is great upside, limited downside when you're buying options. It's a very, very useful tool. You should definitely try and have options somewhere in your financial toolkit if you're vaguely interested in investing in some sort of speculative way. Very essential.
Okay, great. So what are we talking about this time around?
So tonight we're going to be talking about futures and options, a little bit of the history of futures, and especially options and some of the differences between futures and options. It's very important to understand how futures work in order to understand how options work. So back to Greece. On the plasma screen here, we can actually see this is a Greek Phoenician vessel. They were actually called triremes, and you can see it's got oars. You may have seen them in the movie Ben-Hur, that sort of boat. They used to travel around the Mediterranean, and they actually, the ancient Greeks and the Phoenicians, nearly 3,000 years ago, used to use the sort of very similar thing, a forward contract, which is very, very like a futures contract. So when they went round their little trips around the Mediterranean, they'd negotiate and they'd agree to buy something the next time they came around.
All right. And in those days, it would obviously take quite a long time for them to source their goods, I would imagine.
It did. And their voyages took quite a long time as well. So then they would travel around, and their main trade was sort of in glass, bronze, tin, and dyes. They had a very famous purple dye that was sort of the pride of the Phoenician sort of trading empire. And they became a very, very wealthy and powerful city-state that then grew into Carthage, which then had big wars against the Romans. And it's quite interesting because these seafaring nations built up their wealth through trade, and forward contracts were a big part of that.
Okay.
Now, if we skip to much, much later on in history, we can see that in England, there was a massive trade in wool. And if you've seen the movie In Bruges, there's these amazing cathedrals and beautiful, beautiful towns. That was all from the wool trade, which they had in Belgium. So they used to trade wool, and they grew the sheep, were grown in Britain, and they used to ship the wool across to the Belgians, to the Flemish wool merchants, who would then turn it into tapestry and cloth. This was a long, ongoing trade, and they used to use a lot of forward contracts at the time, very, very heavily used, to ensure next season's prices didn't get too far away.
And we still have wool futures today.
Exactly, we still have wool futures. I've actually got an interesting picture that this is the wool sack. Now, the Lord Chancellor of the House of Lords in England still sits on that, and that's a reminder that the wealth of the kingdom between the 13th and 15th century in England was founded on the export of wool. So that wool was very, very essential to their commerce.
Okay, so how did all of this actually formalize into trading on exchanges then, James?
We've got to leap quite a bit further on to Chicago in the 19th century. Most of the trading we know, I mean, the first futures exchange was actually in Japan. It was the Dojima Rice Exchange, which was founded in 1710 in Osaka. But since the 19th century, it's all been about Chicago. Chicago is the center of the world's biggest futures and derivatives markets, and it still is to this day, as you can see with the various options and futures exchanges there. So in the 19th century, there was a great migration westwards across the United States, and they started to grow more and more crops and have more and more livestock in that sort of Midwest region. They had a massive need to get that in an efficient way to the East Coast, where all the people were, where you could actually get it to market. There were big problems because there were massive swings in the price. There'd suddenly be an absolute glut of the stuff getting to the market, and the price would collapse and the farmers would all be ruined. And then there'd be a massive ramp up in the price because there was a shortage, and all the merchants would be ruined. So it was a disaster. So they needed some way to manage price risk. So they started using forward contracts. The problem with the forward contracts is it's very hard to find exactly the right person to trade with, no central place to trade. And also the terms were different, so you couldn't swap one forward contract for another. The other issue was people often reneged on them. So their forward agreement, if the price had moved well away and it would be far more profitable to break the agreement, it was very difficult to legally enforce those contracts. So they decided there was a need for a centralized futures exchange, and in 1848, they founded the Chicago Board of Trade.
All right, so James, this was in around 1848. How did this then change things?
It really made quite a big difference. At first, it was just a better way of a central meeting place for people to meet, and there were some sort of rules set up governing the forward contracts. So only quite a bit later, more than 20 years later, in the 1860s, that they actually started trading futures contracts, which were standardized and fungible. So that created a massive market, and people could manage their price risks more effectively, ensuring that a farmer knew what sort of price he'd be able to get for his crop in advance, and ensuring that the merchant who was buying that crop knew what input costs he would have to his finished goods.
All right, we've got a pic of that Chicago building, don't we?
Yeah, we do. Now,
and it's still there today.
This is still there today. It's quite a monument in the landscape of Chicago, and that's the CBOT building, the Chicago Board of Trade. And that was founded in 1848. This particular building was built in the 1930s. I mean, you can see it's a massive, massive skyscraper. That massive skyscraper shows you that even back then in the 1930s, futures trading was a big business.
All right, James, we're going to leave it there for now. We're pausing for a break, but don't go away, because after the break we'll be chatting about the mechanics of futures contracts. So stay with us.